In this video, I'm breaking down 8 stocks I believe are positioned to be successful heading into 2026 and beyond. These definitely aren't day trades or hype plays. These are real businesses tied to real demand that I believe can compound over time. Before we jump in, please smash the like button and subscribe. It's a small action that you can do that makes a huge impact on this channel. Thanks so much for doing that, and now let's get back to it. So we have to start with AI, but not where most people are looking. AI demand is accelerating much faster than power generation and infrastructure approvals. Data centers take years to permit and build, and power grids were never designed to handle this kind of load. When demand grows faster than supply, the companies that already control infrastructure gain a lot of leverage. That's why I'm focused on AI infrastructure, specifically data center operations. 2 companies that stand out to me are IREN, which was formerly Iris Energy, and Applied Digital, ticker is APLD. IREN focuses on high-performance computing data centers powered primarily by renewable energy. Energy costs are one of the largest expenses for AI workloads. Lower and more predictable energy costs create a long-term competitive advantage. IREN has also announced long-term contracts tied to AI computing demand beginning in 2026. Applied Digital, or APLD, focuses on serving large US hyperscalers, and these customers have enormous computing needs and long planning horizons. The upside is strong demand validation, and the risk is customer concentration. But here's the key point. AI can't scale without infrastructure, and infrastructure takes time. That time delay creates opportunity for companies that are already positioned today and not 5 years from now. All right, moving on to the next stock, Berkshire Hathaway, ticker is BRKB. Berkshire operates across insurance, energy, railroads, manufacturing, and consumer businesses. Instead of relying on one industry or one trend, Berkshire spreads risk across dozens of cash-producing businesses. One of the most important things to understand about Berkshire is cash. As of recent filings, Berkshire holds over $300 billion in cash and short-term investments. That cash gives Berkshire the ability to buy businesses during downturns, support existing operations, and take advantage of opportunities when valuations fall. A lot of investors are worried about the leadership transition as Warren Buffett is passing the baton to the next in charge. But here's what really matters. Berkshire's operated with decentralized management for decades. Individual businesses are run independently, and succession planning has been discussed openly for years. When transitions are planned, markets often overreact, and overreactions can create opportunity for investors like you and me. Berkshire plays a critical role in my portfolio, and it definitely helps to smooth out volatility, protects capital, and allows me to take intelligent risks everywhere else without overexposing myself. Moving on to the next stock, this investment is all about cybersecurity. But before we get into that, many of you know how much time I spend digging through data for these videos. And recently, a lot of you have been curious about the tools that I lean on the most. One platform I've been using consistently and conveniently as the sponsor of today's video is Moomoo. What drew me in is how powerful the platform is. It's used by more than 27 million people worldwide, and that level of trust doesn't happen by accident. Beyond that, Moomoo offers commission-free trading on US stocks, on options, and ETFs, plus 0 contract fees on options. But the real value for me is the depth of insight it gives into individual companies, into market trends, and overall behavior, all of which directly support the research I do for these videos. If something in the market spikes or drops and I need a quick read on what's happening, I can head straight to Moomoo AI. It draws from real brokerage grade data, things like earnings and quotes and options flows, and it gives me answers in seconds. What would normally take hours of digging gets condensed into a moment. And anytime I want to understand what institutional investors are doing, I use their insider shareholder activity features. Seeing how major holders are shifting positions in real time is a huge advantage when I'm forming my own outlook. Moomoo also gives you access to resources that I'd normally pay for separately. Things like Morningstar reports, analyst ratings, premium news, insider trade information, and it's all bundled right into the platform. And once I'm ready to put a trade together, the execution process is incredibly smooth. You can line up ETFs next to each other, compare performance, fees, and tracking accuracy, and scan opportunities across different categories effortlessly. Having real-time options data and free level 2 market depth built right into the platform just makes the decision-making process clearer and faster. So if your goal is to streamline your trading, keep everything in one place, and stop juggling multiple tabs, I highly recommend checking out Moomoo using the link in the description. Right now, for a limited time, when you sign up and make a qualifying deposit, you can receive up to $1,000 worth of NVIDIA shares. On top of that, you'll earn 8.1% APY on your idle cash while it sits idle in your account. All the details are waiting for you below. Huge thanks to Moomoo for sponsoring this video, and now let's get back into it. Moving on to the next stock, this investment is all about cybersecurity. Cybersecurity isn't optional anymore, and it hasn't been for a very long time. That's why CrowdStrike, ticker is CRWD, stands out to me. CrowdStrike operates on a subscription model, which means recurring revenue instead of one-time sales. Recurring revenue is more predictable and more valuable for long-term investors. Once a company adopts a cybersecurity platform, switching providers is expensive and very disruptive. That creates product stickiness and strong customer retention. Okay, moving on. Now let's talk about one of the most important companies in my entire portfolio, and one that I continue to hold with long-term conviction, and that's Microsoft. When I look at Microsoft, I don't just see a tech company, I see a business with massive financial strength, durable revenue, and multiple growth engines that are already proven. First, let's talk about cash and balance sheet strength. Microsoft generates enormous amounts of free cash flow every year, and that cash gives them flexibility. It allows them to invest heavily in research and development, build out global infrastructure, and return capital to shareholders through dividends and buybacks, and still keep a very strong balance sheet. Microsoft is also attractive because of their recurring revenue. Products like Microsoft 365, Office, and Teams are deeply embedded into daily business operations around the world. And then there's the cloud side of the business. Azure continues to grow as more businesses move their data, applications, and workloads to the cloud. And finally, AI. Microsoft isn't betting everything on one new AI product. Instead, they're integrating AI directly into tools people already use and pay for. That lowers risk and increases the value of their existing ecosystem. That combination of cash, recurring revenue, cloud growth, and AI integration is why Microsoft isn't just an AI stock to me. It's a long-term compounder heading into 2026 and beyond. Now let's talk about a company that a lot of people think is at risk because of AI, but that I believe is actually positioned to benefit from it long-term, and that's Alphabet, better known as Google. The biggest concern I hear is this idea that AI chat tools are going to replace Google search. Google's still the gateway to the internet for billions of people every single day. That matters because Google's core business is advertising, and advertisers don't pay for technology, they pay for attention. Google still controls massive amounts of attention across search, YouTube, Gmail, Maps, Chrome, and Android. Even if user behavior changes slightly because of AI, advertisers will still follow where people spend their time, and that gives Google a huge moat. So let's talk about AI itself. Google isn't late to AI, they've been building AI models for years, and now they're integrating AI directly into search, into ads, and their cloud business. The bottom line is this: Google isn't just a search company, it's an attention company, an advertising company, and an AI company operating at massive scale. And that's why I still see Alphabet as a strong, long-term holding heading into 2026 and beyond. All right, moving on, let's talk about fintech companies and digital banking. Younger generations don't want branches, they want speed, and they want everything in one app. That's why I'm watching SoFi Technology. SoFi has evolved from a lending platform into a full digital financial ecosystem. It offers checkings, savings, investing, credit products, and financial tools under one platform. Recent earnings show strong growth in members, in products per user, and in revenue. Member growth is very important because it drives long-term value. As platforms scale, customer acquisition costs tend to decline and lifetime value increases. Digital-first banks also operate with lower overhead than traditional institutions. There are risks including credit cycles and regulation, but the long-term shift towards digital banking is clear. That's why I think SoFi is well positioned now and gonna grow long-term, and it's becoming a larger part of my portfolio every time I review it. The final investment on this list is all about balance, risk management, and long-term stability. And that's Vanguard's Value ETF. The ticker is VTV. VTV is designed to hold established companies that trade at more reasonable valuations compared to higher growth stocks. These are businesses with consistent cash flow, mature operations, and products or services that people rely on regardless of how the economy is doing. Inside VTV, you'll find companies across sectors like financials, healthcare, consumer staples, and industrials. These aren't speculative businesses, they're banks, insurers, healthcare providers, and household brands that have survived multiple economic cycles. That helps reduce volatility, especially during market pullbacks when growth stocks tend to get hit the hardest. Another important aspect is dividends. Many of the companies in VTV return cash to shareholders, which can provide income and help offset market swings over time. For me, VTV plays a very specific role. It's not meant to be exciting, it's meant to be reliable, and it helps stabilize my portfolio that also includes higher growth investments, and it allows me to stay invested through market uncertainty without feeling forced to react emotionally. That kind of balance is what keeps investors in the game long enough for compounding to actually kick in. When you step back to look at this list, the point isn't to predict the next hot stock or chase whatever's trending. It's about building a portfolio that actually holds up over time. You've got exposure to growth through AI and technology, but it's backed by real infrastructure, recurring revenue, and strong balance sheets. If this video helped you think more clearly about long-term investments, make sure to like and subscribe. It really does help the channel a lot, and it'll help more investors looking for this information. Thanks for watching, and I'll see you guys in the next one.